Welcome. In this video, XCN can go up 250%. What is the reason? We will analyze this. Don't forget to like, subscribe, and please watch to the end to understand.
The downward trend structure observed on the chart is a technical pattern that typically forms as the price progresses with lower highs and lower lows over a certain period. This structure represents the general selling pressure in the market and weakening buying power. The downward trend line usually acts as a resistance line that the price has attempted to break to the upside several times but failed. As long as this trend continues, investors tend to maintain bearish strategies, since each contact with the trend line tends to trigger renewed selling activity. However, when this downward trend is eventually broken, meaning the price moves above this resistance line and manages to stay above it, this is considered a very positive development in technical terms. Breaking the downward trend signifies a major shift in market psychology. This breakout shows that buyers are now stronger and sellers have lost control. In technical analysis, this breakout is often interpreted as the beginning of a new upward trend, especially if the price breaks above the descending trend line and then successfully retests it as a support. This can mark the start of a new bullish wave. At this point, investors may increase their long positions, as the breakout indicates the market is moving within a different dynamic. The break of a downward trend line is typically accompanied by an increase in volume. Volume, meaning the rise in trading activity, confirms that the breakout is genuine and that a strong group of buyers has entered the market. If volume remains low during the breakout, its sustainability may be questioned. That's why investors closely monitor not just price action but also volume data. A breakout supported by strong volume often signals a healthier and more powerful upward move. On the other hand, breakouts without volume often result in pullbacks, and investors should keep a close eye on their stop-loss levels in such scenarios. The price action that follows the break of a downward trend is often referred to as a breakout, and the candlestick closes after the breakout are crucial. If the price manages to close several candles above the trend line consecutively, this is considered technical confirmation of the breakout. In such cases, market participants gain confidence and new buy orders may come in. The upward moves that follow breakouts often cover significant ground in a short period. For this reason, investors aim to time their entries correctly by closely watching for such breakouts. The price beginning to move upward after breaking a descending trend line creates a hopeful scenario for investors, especially for those holding positions during the previous decline. This breakout presents an opportunity to recover losses or generate new profit potential. At the same time, the breakout can create momentum in the market and trigger a shift in general market sentiment. Buyers who were previously hesitant may start entering positions following the breakout, further accelerating the price's upward momentum. In summary, the descending trend structure observed on the chart plays a critical role in technical analysis. Breaking this structure indicates that buyers are regaining strength and that the price may be entering a new upward phase. Therefore, downward trend breakouts are among the most closely watched technical patterns by investors. When such a breakout occurs, volume, indicator signals, and the price's reaction afterward must be carefully analyzed. By combining all these data points, investors can make more informed decisions and better manage their risks. A price breaking above a descending trend is a positive signal in technical analysis and holds significant potential for continued upside. That's why such breakouts should be closely monitored, strategies should be prepared carefully, and market dynamics must be continuously followed. But we can't base our decisions solely on trend lines. Let's now take a look at other metrics. Stay tuned.
RSI is a highly valuable oscillator frequently used in technical analysis to indicate whether the market is in overbought or oversold conditions. This indicator has values ranging between 0 and 100, and typically, values above 70 suggest the market is overbought, while values below 30 indicate it is oversold. However, the true strength of RSI is not limited to these classic thresholds. When analyzed alongside trend lines, RSI can generate very strong signals. This is where the concept of a downward trend line on the RSI comes into play. Downward trend lines that form on the RSI create certain resistance levels, just like on a price chart, and the break of these resistance levels can often be a precursor to strong upward price movements. Looking at the current setup, there's a clearly observable downward trend on the RSI indicator. This trend has been drawn by connecting the peaks on the RSI, and each time the RSI approached this line, it either consolidated or came under price pressure. Now, however, the RSI is very close to this descending trend line and may be on the verge of a breakout. This setup is a signal that investors should monitor closely, as a downward trend breakout on the RSI can often be an early sign of a sharp price acceleration. This is a highly critical technical detail that investors should consider before entering positions. This downward trend structure in the RSI generally indicates that the market has been experiencing weak momentum for some time, but that this weakness may be nearing an end. The downward trend line on the RSI serves as a sort of hidden resistance. When RSI successfully closes above this line, market psychology begins to shift. Investors interpret this move as a strong increase in momentum, which leads to faster buying on the price side. At this point, the breakout observed on the RSI is usually supported by a simultaneous breakout or rise in price. Moreover, it is known that trend breakouts on the RSI can give earlier signals than those on the price chart. In other words, a downward trendline breakout on the RSI can provide a signal before the price itself shows upward movement. This gives the investor the advantage of entering a position early. In this respect, RSI trend lines fall into the category of leading indicators. If RSI breaks this descending trend, it not only signals the beginning of upward momentum, but also suggests that the market is ready to enter a healthier uptrend. Following such RSI trend breakouts, it is also very important for the indicator to move above the 50 level, because the 50 level on the RSI is considered the balance line between bulls and bears. If RSI breaks the descending trend line and then settles above the 50 level, this indicates that buyers are becoming dominant and the uptrend may be more sustainable. Especially when RSI enters the 60-70 band, it confirms that the price rise is accelerating and momentum is increasing. At this point, RSI entering the overbought zone can sometimes worry investors, but when the trend is just beginning, RSI staying above 70 can be a sign that the rally is strong. The breakout of the descending trendline on the RSI usually leads to a rise toward the 70 level and often results in the RSI staying in that region for a while. During this time, price typically moves upward in a similar fashion and starts to break through previous resistance levels. Additionally, the retest movement that occurs after the RSI breaks a descending trendline is extremely important. Sometimes the RSI will return to test the trendline it just broke. If this test is successful and the RSI begins to bounce upward again, it can be interpreted as a buying opportunity. This pattern confirms the sustainability of the trend reversal and signals a strong upward move in the market. These types of retests on the RSI often correspond to support resistance flips on the price chart. While all this is happening, another element investors should pay attention to is the potential for positive divergence between RSI and price. If the RSI is moving within a descending trendline while price continues to fall, but RSI shows less downward movement, this is a positive divergence. If RSI breaks its trendline during this divergence, it can be a very strong buy signal, indicating that market momentum is beginning to rise again. Especially if RSI is forming higher lows while rising, it is a sign of an upcoming upward movement. Furthermore, this RSI trend breakout is critical not only for short-term investors, but also for medium and long-term investors. These types of breakouts on the RSI can signal not just short-term moves, but the beginning of trends that last for weeks or even months. Therefore, RSI trend breakout should be analyzed and evaluated across all time frames. With the break of the descending trendline on the RSI, investor sentiment usually turns positive as well. People interpret this move as a strong technical signal and further support the price rally. At this point, trading volume typically increases. This increase in volume is seen as a confirmation of the price movement. If volume rises along with the RSI and price follows, this triple confirmation mechanism indicates the beginning of a solid upward move. In conclusion, the descending trendline that forms on the RSI and its breakout presents an extremely important technical structure. If RSI manages to break this ascending trend, it not only means the RSI is shifting direction, but also signals that the price is preparing for an upward breakout. This breakout on the RSI is typically interpreted as a strong buy signal and can result in the market entering a new bullish wave. Therefore, RSI trend lines are not just a minor detail in technical analysis, they serve as a strategic roadmap. Investors who read this setup correctly and time it well often have the opportunity to enter positions before major market moves and gain significant profits. If RSI rises, the price will rise.
The W pattern is a powerful chart formation frequently used in technical analysis that signals a potential trend reversal to investors. This formation consists of two bottoms and a peak in the middle. It typically occurs at the end of a downtrend and indicates that buyers are beginning to regain control of the market. Therefore, the W pattern is also known as the double bottom pattern and is often a precursor to a bullish breakout. In the current scenario, the price is exactly at the second bottom of this W pattern. This is a highly critical point, as a strong buying wave from here could lead to the completion of the pattern and a significant upward movement in price. Especially if the rise from the second bottom is supported by volume, it reinforces the validity of the pattern and gives investors greater confidence. The first bottom of the W pattern typically represents the final stages of the downtrend. At this point, selling pressure has peaked and the price experiences a significant decline. The subsequent upward move indicates that investors are gradually beginning to trust the market again. However, this rise eventually encounters resistance and the price price begins to fall once more. The second bottom that forms during this decline usually aligns with or is slightly below the level of the first bottom. What's important is that this second dip signals weakening selling pressure and a loss of strength among sellers. Right now, the price is precisely at this second bottom level. If a strong buying wave starts from this point, the W pattern's bullish potential is activated, and the price is expected to rise up to the neckline, which marks the starting point of the pattern. To complete the W pattern, the price needs to gain upward momentum after the second bottom and break above the middle peak, also known as the neckline. This breakout typically occurs with strong volume and confirms the validity of the pattern to investors. If the breakout is strong and supported by volume, the target of the pattern can be calculated. The target is usually determined by adding the distance between the bottom and the neckline to the breakout point. In this case, it's been noted that there is a 250% price difference between the pattern's bottom and peak. If the price fulfills the pattern requirements and breaks above the neckline, the likelihood of reaching that 250% target significantly increases. This means high profit potential for investors. The upward move from the second bottom of the W pattern is typically strong as both technical traders and large buy orders tend to become active at this level. This strengthens demand and drives the price upward more rapidly. Especially if there is a flow of positive news at this point, investor confidence increases and the price rises quickly. Additionally, many algorithmic trading strategies automatically recognize such patterns and initiate positions, further supporting rapid upward moves. Therefore, the fact that the price is currently at the second bottom increases the probability of this scenario playing out. After the rise to the neckline, the price often consolidates at that level for a while. This consolidation process allows for the formation of new support levels and enables investors to take profits. However, this period is usually considered a preparatory phase before a new wave of upward movement. If trading volume drops during this consolidation and the price moves sideways without pulling back, investors tend to interpret it positively. This is because it suggests weak selling pressure and that a new upward breakout may be near. The potential rise offered by the W pattern can be a highly attractive opportunity for investors. However, there are certain aspects to watch out for during the formation. In particular, buying before the pattern is complete can put investors at risk, as the price may reverse again if the expected breakout from the second bottom does not occur. Therefore, entering large positions before confirming the pattern is risky. The safest strategy is to buy after the neckline is broken or during the retest that follows the breakout. Such a strategy minimizes investor risk and supports a more informed decision-making process. A 250% rise potential is undoubtedly attractive. However, for this potential to materialize, both technical and fundamental factors need to be supportive. For example, positive news about the project, partnerships, product updates, or improvements in overall market conditions during the pattern can trigger the rise. Otherwise, trades based solely on technical signals may fall short of expectations. That's why it's important for investors to consider the broader market environment and developments related to the project when evaluating such patterns. In the current scenario, with the price at the second bottom of the W pattern, investors may be facing a major opportunity. If a strong upward move starts from this level, breaks the neckline, and moves toward the target, it could provide substantial gains for investors. Of course, patience is required during the formation process, and technical signals must be carefully monitored. Patterns mature over time, and acting impatiently can sometimes result in missed or failed positions. In conclusion, structures like the W pattern are not just random shapes seen on price charts, they are reflections of market psychology. These formations represent the battles between buyers and sellers and the psychological resistance and support levels. Therefore, they hold a significant place in technical analysis. If the price, currently at the second bottom of this formation, experiences a strong breakout, confirming the pattern, it could open the door to a 250% potential gain for investors. For this reason, such patterns should be closely monitored and strategically evaluated. When properly interpreted, the W pattern is not just a chart structure, it can be a compass that helps investors capture future opportunities.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.